Today we are talking all about HP Inc. stock, and in this video I'm going to walk you through our complete valuation process where we will do a quick company health check. We're going to run the numbers and do the valuation. We're also going to check to see if any super investors are buying or selling this stock, and finally we will look at some very practical ways that we might consider building a position in HPQ. And I want to thank everybody who suggested that we do HPQ in our next valuation video and all of you who voted in our poll. We love hearing from you. Before we get started, I want to let you know that this video is going to be slightly different from some of the other valuations that you will find on our channel, where we would normally look at 10 years worth of historical data about that company. And this is because back in 2015, Hewlett-Packard actually split into two different companies. So they have HP Inc., which is the divisions focused on personal computers and printers, and they have HP Enterprise, which is their enterprise and business services. HP Inc., which is the company that we're focusing on today, retained the historical ticker symbol and stock prices of the original company. This means that if we were to look at that data for HP Inc. prior to 2015, we're going to get all of the historical numbers from the old company. And if we were to include them in our valuation, this would really mess up our numbers. So for the rest of this video, we are only going to be looking at the historical data for HP Inc. after the split occurred. And the other important note for this video is that I pulled data from lots of different sources and different websites. So I'm going to be showing you the numbers on the screen, but if you want to verify any of the data that I'm presenting today, in the description, I've got all of the links for the different websites that we used in order to do this valuation. All right, let's dive right into the company health check. So as value investors, we believe that whenever you are buying stocks, it's not just about clicking on some numbers that you see on your computer screen. It's actually taking the approach that when you invest in a company, you are becoming a partial owner of that business. So therefore, it's really important for us that before we even consider making an investment, we really understand the fundamentals of that business. And those fundamentals are numbers. They are facts about the business that you can pull from publicly available data that is going to give you insights into how well management allocates capital. You want to look at things like how they preserve shareholder value, how they handle their debt, and how they might respond in an economic downturn. So the first thing we're looking at for our company health check is their ability to pay off their debt. And what we want to see is how many years of cash flow it would take them to pay off their long-term liabilities. The lower the number, the better, but as a rule of thumb, Chris and I really like to see that a company can pay off its debt within 5 years or less using their cash flow. And if not, it's a signal for us that we need to dive deeper into understanding that company's numbers. In the trailing 12 months, HPQ had $5.8 billion in free cash flow, but that's actually higher than the average of other recent years, probably because of the increased profitability of people buying devices and working from home. So in order to be on the safe side, I'm actually going to average out the free cash flow for the past 5 years, and that gives me a number of $4.1 billion. And $4.1 billion is a number that I feel much more comfortable with because I feel like it's something that they can hit consistently in the coming years. They currently have a little bit more than $11.1 billion in long-term liabilities. So that means using their free cash flow, they could pay off their debt in about 2.7 years. And this gives them their first check. The next thing we like to make sure of is that they have a strong return on invested capital. And as a rule of thumb, Chris and I like to see at least 10%. Now, if we look at HPQ, we can see that number is 19%. So that gives them another check. Now let's talk about growth. We like to see that their revenue, earnings, and most importantly, cash flow are all trending upward. Looking back 5 years, their revenue was $48.2 billion, and last year it was $56.6 billion. Earnings were $2.5 billion, and last year it was $2.8 billion. And their free cash flow was $2.8 billion, and last year it was $3.7 billion. Okay, that shows growth. Let's give them another check. Next, we're going to take a look at the outstanding shares to make sure that they are not diluting the value of the shareholder. Sometimes you can see that companies will issue new shares in order to generate cash for them to run the operations or grow their business. But Chris and I much prefer a company that uses their cash flow in order to do that. 5 years ago, their shares outstanding were 1.7 billion, and today they're at 1.152 billion. So that actually means that they have been buying back shares. So this is a good sign for us, but before I give them their final check, it's important for you to note that you should look at what price a company was buying back their own shares to see if you think that they bought them back at a fair price. All right, they get a check on this metric. And the last thing that we're going to look at is the safety of the dividend, which is currently yielding 2.66%. So to figure this out, we are going to compare the amount they paid in dividends versus that same free cash flow number that we used when we were talking about debt earlier on in the video. And this calculation lets us know how comfortably they can pay those dividends. In the trailing 12 month, they paid out about $1 billion in dividends. And if you compare that to the 4.1 in free cash flow that we had calculated earlier, that says to me that their dividend is pretty well secure. And that's the final check, which means that HPQ has a clean bill of health. Okay, before we move on to the valuation, it's also really important to remember that a company is more than just its numbers. We strongly believe that any company you want to invest in should be one that you understand, should be one that has great, capable management, and should be one that has strong, durable, competitive advantages. These are all the things that are going to keep the business healthy and protect our investment. And any assumptions that you make on a company based off of the numbers, you should back up with narrative and research. And you can do this research by reading letters to shareholders, listening to earnings calls, and also watching interviews that management gives to the press. All right, you ready to start crunching some numbers? Let's move on to the valuation. Essentially, a company valuation is our attempt to predict the future performance of that company in order to decide what we would be willing to pay for shares of that company today. And it involves pulling some key numbers, making informed decisions about other key numbers, and then plugging all of those numbers into equations. And today we are going to do a valuation of HPQ using a discounted cash flow calculation. We will use a terminal multiple after 10 years. This means we are going to forecast the cash flow for each of the next 10 years, and we will assume that we will sell the company and collect a sum. Then all of these cash flows will be discounted back to a value of today by our desired rate of return. And this method requires 4 key numbers: trailing 12-month free cash flow per share, expected 10-year growth rate, 10-year free cash flow multiple, and your desired rate of return. First, we're going to take a look at the trailing 12-month free cash flow per share. We pulled $5.8 billion from yahoofinance.com, so we need to convert that to a per share cash flow by dividing it by the number of shares outstanding, which is 1.152 billion, to get 503 free cash flow per share. But remember, their FCF was higher in the trailing 12 months than it has been over that 5-year average. So we're going to use 4.1 billion as the starting cash flow in our valuation. It's the same number we were using before earlier in the video. And we're going to redo the calculation to get a new per share value. So I'm going to divide 4.1 billion by 1.152 billion outstanding shares to get 356 free cash flow per share. Okay, 356, we've got it. This is the number that I want to use, and now I'm going to head over to our cheat sheet so that you can see exactly what we have thus far. All right, here's where the real work begins. Now it's time for us to make some educated predictions about how we think HPQ is going to grow over the next 10 years. And in order to make this decision, I'm actually going to look at the historical growth figures from the past 5 years. Important side note, don't forget that past performance is no guarantee of future results. So just like with our other assumptions, you should really back this up with additional research and more narrative to your story. Okay, back to historical growth. So there are 2 ways that you can calculate this number, the quick way and the more complete way. Let's start with the quick way, using the compound annual growth rate formula you see on the screen. We like to embed the formula in our Excel so it can do all the hard work. Okay, for this valuation, we are going to look at both earnings and free cash flow in order to give us a more full picture of what its growth potential will be in the future. For earnings, we are using $2.496 billion for the first value and $2.844 billion for the final value. And this gives us 3.3%. For cash flow, we are using $2.797 billion for the first value and $3.736 billion for the final value. And this gives us a growth rate of 7.5. The problem that I have with only using this calculation is that it looks at data from 5 years ago and from today, and it ignores everything in between. So it's really important that if you're going to use this calculation only, that you make sure that the data you're plugging in are not outliers, because this can really mess up your valuation. Okay, now let's move on to the second way I had mentioned before, which I feel like is the more complete way, and it's definitely Chris and mine's preferred method, and that is to chart the growth in Excel. Let me show you exactly what we do. First, I plot the last 5 years' results, then I use the numbers to create a scatter plot chart, adding an exponential trend line, and finally, I make sure to label the trend line with the equation. The exponent of that equation is the compound growth of the earnings. Again, I like this method because it uses more data points and it allows me to really easily see if there are any abnormalities or outliers. And that gives me a trigger that I need to dig in and understand more about what happened during those years. And if I can, then I can move on and continue my valuation. But if I can't, that means I put this in the no pile and I move on to valuing our next company. But just something to watch out for. This method only works if all of the data entry points are positive. The growth from the charts are earnings at 4.8% and FCF at 7.7%. All right, so it's showing us that over the past 5 years, they have had low kind of single-digit growth rates. But here's the problem I have. We are only looking at 5 years because that's what we have to do. And normally, Chris and I would like to look at 10 years worth of historical data in order to make a more accurate prediction about the future. Also, if you know Chris and I, you know that we tend to be very conservative in our growth rate projections, and we do this in order to try to protect our investments as much as possible. So even though you guys might get mad at me, I'm actually going to use a growth rate of 2% from here on out for the rest of the valuation. Okay, we have trailing 12-month free cash flow per share. We have our expected growth rate. Now we need to determine what multiple to FCF we think HP Inc. will have in 10 years when we're assuming that we are going to sell our position. So for this number, we like to use the number 10, which is pretty conservative. Sometimes we might go up to a multiple as high as 15 if we think that there is still significant growth potential in the company. But 10 is a generally good number across different industries and across different market conditions. So 10 is the number that we're going to stick with. All right, the last thing that we have to decide on is our desired rate of return. So for Chris and I, the desired rate of return that we typically use is 15%. For some of you, this might seem high. For some of you, this might seem low. The reason this is our sweet spot is because we know that if we were to just invest in indexes, we would probably do about 10% returns. So since we are spending all of this time actually researching a company, we want to get more than 10%. Now, on the flip side, if we were to make our desired rate of return at like 50% or 30%, this can sometimes keep us out of the market, especially with how the market is performing these days. So 15% is the number that we're going to use in our evaluation, but of course you can adjust this to meet your own requirements. Remember, valuing a company is highly subjective. The rate of return you want to receive, the depth of understanding you have about that company, and your risk tolerance are all things that are going to impact your final valuation. All right, let's review. Trailing 12-month free cash flow is $356. 10-year growth rate, 2%. FCF multiple in 10 years, 10. And desired rate of return, 15%. With these four numbers, we can now do our valuation. All right, let's grow our trailing 12-month free cash flow by 2% over the next 10 years. Here, we assume that we are going to sell in 10 years at a multiple of 10. And now we bring each of these cash flows back to today's value using the present value formula that you see on your screen and where we have plugged in our desired rate of return of 15%. And this gives us an intrinsic value of $30.22 per share. On the day that I'm filming this video, HP Inc. stock is currently trading at a little bit more than $37 per share. So it's a little bit out of our price range. But it's close enough that there may be some opportunities to use options in order to get into a position. So let's hop over to Yahoo Finance and look at the current option chain for HP Inc. We're looking at the 21st of January 2022 options, which on the day of filming are 49 days from expiration. The put options at the $30 strike price have a premium of 22 cents, so someone is willing to pay us 22 cents per share for us to buy HPQ for $30 per share for the next 49 days. So let's do the math and see if this is appealing to us. To calculate our annualized return on investment, let's first calculate our risk capital. This is the strike price minus the premium we collect. 30 minus 22 cents equals $29.78. Our potential upside is the premium of 22 cents, so we divide 22 cents by our risk capital of $29.78 to get 74%. And then we are going to annualize it by multiplying it by 365 divided by our days to expiration of 49 days to get 5.5%. So we don't really consider 5.5% a really great return, but if we don't have anywhere else better to put our money, then we might consider it. And just as a final check, we want to see if there are any super investors either buying or selling HPQ. Now for us, this isn't a deal breaker, but it's always good to have a little bit of extra reassurance. Currently, one super investor has invested over the last 6 months and 8 have actually sold out. Now, HPQ has nearly tripled since March of 2020 lows, so it could be that investors are just looking at excellent returns and so they're selling. But we would definitely keep digging in order to validate this assumption. In conclusion, Chris and I are currently not investing in HPQ, but we are going to keep it on our watch list to see if the prices will drop down to hit our strike price. Before I leave you, let me ask you the question of the day. At what price would you buy HPQ? If you like this video, you might want to check out some of our other valuation videos that you see here. But remember, I am not a financial advisor and I am definitely not your financial advisor, so make sure you are making your own informed decisions when it comes to your investment portfolio. Thank you so much for watching. I really hope that you found this video useful, and if you did, please let us know by liking and subscribing to our channel. We love to hear from you in the comments, so let us know what companies you would like us to evaluate in our next video. Remember, earn more, spend less, and invest the rest, and I will see you next time.